Hello and welcome. You're watching Business Today TV. I'm Sakshi, Batra, and on this special edition, we're going to be focusing on the impact on the debt mutual funds schemes and the overall industry after the finance bill was passed by the Lok Sabha with 64 amendments on Friday. Remember, the bill includes some of the amendments which seek to withdraw some of the long-term tax benefits on certain categories of funds. And as per the changes, the gains from mutual funds where not more than 35% is invested in equity shares of the Indian companies will now be deemed to be short-term capital gains, and that's with effect from 1st of April 2023. Also, debt funds held for more than 3 years will no longer enjoy the indexation benefits. Additionally, they won't be eligible for a 20% tax rate as well. And to understand more on this and to get more insights as to what does it really mean for the industry at large and how does it impact the mutual fund investors, especially in the debt fund category, and what should be their investment strategy from now on, I'm joined by somebody very special on this show. Mr. Balasubramanian joins in. He's the MD and CEO at Aditya, Birla, Sun Life AMC, and he's also the chairman of AMFI. Welcome, sir, and thank you so much for taking the time out for this discussion. It's been a very, very eventful last weekend for you, and I'm sure especially for you, your phone wouldn't have stopped ringing for a whole lot of people would have been wanting to understand from you the impact of all of this. So I wanted to take first your reaction. What was your first thought when you heard about this amendment in the finance bill? And as per your understanding, how will this really change life for AMCs at large, and what will be the impact of this on the total assets under management for AMCs?
Yeah, no, thanks Sakshi for having part of the show today. I think first reaction as we came to know on Thursday night that there's an amendment that is being now introduced in the finance bill. Of course, all of us were taken aback and surprised that how come this has all of a sudden has come and was not being part of the budgetary provisions. And then of course we try to understand what is the background from which it has come, and is there anything that can be done by way of making representation through AMFI as well as SIB. While that's an effort that we are immediately getting into action in terms of what we can do. But having said that, then as the amendment got passed in the parliament, then actually we have to make an assumption that that the amendment has now become final, and therefore we have to live with for the time being what has been presented. I think what came as a surprise is given the fact that Indian mutual fund industry have been growing at a very steady state of growth, and having close to about 16 lakh crores coming in the fixed income out of the 40 lakh crore that Indian industry has been managing. And the mutual fund also been playing the role of one, channelizing the savings into the capital market, both in equity as well as in fixed income. At the same time, provides a greater depth to the corporate bond market in the country. And we have been a provider of another source of financing for most of the company needs, and we have been doing. Therefore, these taxations introduction was a bit surprise for us, given the fact that the role that we are playing actually benefit both investors on the one side and the capital market on the other side, and third is the corporate bond market development on the other side. Therefore, we are a bit surprised, but anyway, government has gone by that assumption that we need to have a uniform taxations across all products, across all industry players. I think probably the finance minister has been living up to her own the effort that she is taking for simplified tax structure. So going by that, I think they seems to have taken it in the final bill when they were getting amended.
Right. So are you hopeful for a review, or do we have to live with this for the time being now?
I think the way I assume is unless there is a provision that they can that they can use it for reversing what they have done, but it looks doubtful to me given the fact that it got passed in the parliament. Anything that got passed in the parliament, I would assume that become sacrosanct. If at all it has to get reviewed, probably it can get reviewed the subsequent budget. So I assume unless the actually whatever the representation, that noise that has been made by all the industry players and including regulator giving some kind of data points on various things, if it makes their mind change a bit, then we are going to be surprised.
Sure, absolutely. But if you could help all our viewers really understand, because of these amendments, till the time now we are taking it as sacrosanct and it will eventually get implemented from the 1st of April, which are the categories of funds that will be most impacted with this?
See, I think existing funds not much will get impacted, and the sense that whatever is available investment that is there till 31st of March this year will continue to have this LTCG benefit by way of grandfathering. It's only for the new investment that will come from 1st April. The new taxation will be applicable, where anything that comes into the mutual funds in fixed income schemes coming from 1st April 2023 will only be eligible for short-term capital gain tax benefit, not the long-term capital gain tax benefit, which otherwise existing. Therefore, existing investment will not get impacted. On the contrary, post this provision, lots of people who actually was postponing their investment to come to the April, saying they will make in April, as soon as they have money, they will do it, or they have money lying in the say liquid fund kind of things. All such investors are now suddenly thinking about why not actually invest before 31st of March itself. When I have money, if somebody doesn't have money, of course you can't do anything. If somebody has got money lying in any of the debt funds, I think they are currently now start thinking about how can I actually lock in myself to get the LTSG benefit for long term. But one thing that I think is also there, that most of the investors who come to debt funds, generally they don't have the tendency to withdraw the funds unless and they have some needs. So to the extent, I think I would assume most of the people, such people who have some other plan of action on those investment would come. And second is those who actually been going after fixed deposits, saying let me lock my money in fixed deposits, that is giving a better return. And even such investors can temporarily move from fixed deposit to the mutual funds, and the window that is available from now till 31st of March is the only window is available. Maybe such investors could also come.
Yes, exactly, because most of the mutual funds are also reopening schemes for investors to perhaps give them an opportunity to lock in their funds and to get the LTCG benefit before the 31st of March as well. Your sense on what do we expect from the numbers? I mean, of course, the numbers will come in after the first week of April, but in March, do you expect the flows to increase in debt funds?
Yeah, I think the flows will increase. It could either move from one scheme to other schemes in order to plan their long-term investing through this route. And second, those who have been parking money outside, thinking that I'm getting a steady state of return about 7.5%, still they are taxable. And such investors could also, of course, come into mutual. So there is no estimate at this point of time, but at least the message has been very clear from mutual industry that whoever wants to actually at least get the last opportunity LTCG benefit on fixed income schemes, maybe this is the time to come in. This is the last opportunity, unless until the next budget.
Sure.
They realize what they have done is actually detriment to the growth of the industry, as well as detriment development of the corporate bond market. If they reverse it, then it's nothing like it. But let us assuming it's become permanent, then whoever comes in before the 31st of March will also get this benefit of LTCG, because the differential is actually is not very large, but however, from a government point of view, the incremental revenue that they will get on the base of this is not very significant. We also done some kind of calculation. By doing this, actually, if the government has become significantly richer by way of more tax and more collections, it doesn't. And keeping this in mind, suppose they realize this the next few years and then reverse it, nothing, then we will not be able to judge at this point of time.
Okay, but given the kind of amendments we are working with right now, is it clear advantage fixed deposits right now?
No, advantage we cannot say. It comes at par, in fact. I think from 1st April, there will not be any difference on taxation. Difference will not be there. However, in the case of FD, any income that you get is an accrual of income. Therefore, the income that is accrued will be taxed by way of income accrual. The case of mutual fund, it comes in the form of NAV growth. So therefore, it comes in the form of short-term capital gain, in the form of growth in the value. So short-term capital gain tax can also be adjusted against the short-term capital loss. Again, depends upon how one does the tax planning by themselves. Therefore, while the tax treatment becomes equal, but I think the way the accounting is done in the case of fixed deposits is income in the hands of people. In the case of mutual fund, it's actually growth in the NAV becomes not an income, it's a form of a growth. The growth today is considered as a short-term capital gain. Therefore, it actually gets qualified to get adjusted against the short-term capital loss.
Okay, understood that. But where do you really see most most of the money flowing into now? Would it be FDs? Would it be the equity savings funds, hybrid funds? Would it also be the sovereign gold bonds or even insurance investment products? How do you assess this entire scenario to bring this change in money flow?
So I think till 31st of March, I would assume preference would always be to the mutual fund, given the fact that the only opportunity you get for one to actually go and invest your money for long-term purpose. And then whatever the requirement that you may have in the subsequent period, you manage it through your normal cash flow that comes in, whether it is for individuals or it is for the SMEs and the family offices. That's one I see it till the 31st of March. I think moving into the next financial year, of course, those who want capital gain, short-term capital gain, and therefore short-term capital gain can also be crystallized only at the time of redemption. That one must note, only at the time of redemption will get crystallized. In the case of any other investment that you make, or especially in FDs, it gets crystallized every year from income tax point of view. Therefore, that you will get an advantage. Having said that, since almost all products are becoming at par when it comes to the question of tax rate applicable, I'm sure some bit of benefit will also go to the insurance, the guaranteed kind of product up to a certain extent. And also, and if those who are used to putting money in, of course, in FDs, those who are in the lower tax bracket do not worry about taxation per se. They may continue to go for FDs. But I think the mutual fund would be in some disadvantaged position. At the same time, if you look at the total 16 lakh crores, roughly about 80% of the money comes for 1 to 2 year kind of things.
Yeah.
And that will not get impacted. I think that will come more or less remain the same. Only the money that comes in for long term, which is about 20%, which is roughly about 4 lakh crore size. The rate of growth could probably be reduced given the change in tax structures.
Okay, but would you say, sir, looking at this scenario and looking at the bigger picture, is it becoming pretty much clear that the government will eventually remove the long-term capital gains on, say, even listed equities and tax all the capital gains on sale of listed shares at STCG rates or as per one's personal tax slab going forward?
I doubt, actually, given the fact that government also knows very clearly the need for developing the capital market in India. And in fact, if India has to become, say, $26 trillion economy in the next, say, 10, 15 years, then we need to also gun for $26 trillion of equity market cap. So that will always come only upon favorable, friendly capital market regulation. Therefore, I doubt, given the fact that India needs still significant amount of risky capital to fund the growth, both to the government as well as for growing the Indian companies' aspiration. Therefore, I think it's not right to extend the argument that LTCG removal for fixed income is actually precursor for removing LTCG for other instruments. And in fact, government has been quite proactive in ensuring the capital market instruments get developed. And therefore, on the contrary, I would assume after sometimes, if there is no significant, say, what do you call, if there is a reduction in the corporate bond market development, as you may happen in the next 1.5 years, I would assume they'll probably consider the reverse, that bring back certain tax benefits, even in the interest of corporate bond market development in the country.
Okay, what would you really say to a conservative investor right now out there who has been thinking of shifting money from FDs to debt mutual funds? What should they now understand from all of this scenario? How should a fresh investments be taken from FY24 in terms of the debt or fixed income instruments? What would you advise to the conservative investors out there?
See, I think conservative investors, those who come in the low tax bracket, they can of course continue to be in the FD, and given the fact that gives them some bit of guaranteed return, and there's element of safety which they always consider. And those who come in the higher tax bracket, and those who have high income payers, income tax payers, the definitely mutual fund would still be a better option, given the fact they do get short-term capital tax benefit, can be adjusted against the short-term capital loss, and everybody thinks actually they only make profit all the time to pay tax. People also make losses actually in their investment, as we have seen recently, the equity market volatility. So therefore, it's always better to have that options with them. And naturally, from SMEs and corporate investors' point of view, I think mutual fund will continue to remain a vehicle, but they don't actually come for LTC benefit. They always come for parking their money as a better alternate to any other investment that they have. I think that segment, I think, will continue.
Okay, and in the end, I also wanted to take your view on, as we are just at the beginning of FY24, what is your own sense of how will investors be really viewing their own investment opportunities in this financial year? Will equities continue to dominate other classes, or will other asset classes really supersede, outperform? How should investors really approach their investments in FY24? Your outlook?
Yeah, I think clearly, Sakshi, I think equity is something. It's a long-term investment avenue. Therefore, our own belief is this year equity will remain volatile, no doubt, with a limited downside risk and limited upside potential. Given the global volatility we are saying, therefore, it's a time to accumulate equity. There's no question doubt on that. At the same time, fixed income, given the fact the rates are pretty attractive, we were quite vocal in actually giving fixed income as one alternate asset class, and that now being somewhat derailed from the form from the taxation change. Definitely, hybrid funds would become the way forward from investors' point of view. At the same time, multi-asset fund which invest in all the four asset classes: equity, fixed income, gold, and silver. All the four asset classes which comes and could also be another good opportunity for investors to look at as part of the asset allocations. Given the fact when gold as an asset class, our own belief is they will continue to do better. Not necessarily give a significantly higher return than fixed income or equity. As an asset class will do relatively better. Even silver as an asset class should do better. Therefore, the combination of the four asset classes in the multi-asset fund is something we also believe that could be one of the options that could be there for 2024.
Understood. Well, thank you so much, Mr. Balasubramanian, for being with us and sharing all these insights with all our viewers, helping us give more clarity as to how should one really understand the amendments and go forward with their investments. This is definitely something that we have to work along with and then see what exactly works best for an individual investor going forward from here, now that this amendment is a reality. But we'll keep a check on whether the government really looks at your own suggestions, and you've been saying that the industry is also looking at presenting their views to the Finance Ministry at this point in time, and we'll have to wait to see whether the government really looks at all of that as well. Many thanks for being with us, and on that note, we'll wrap it up at that, but do stay tuned on to Business Today TV for a whole lot of action on the D Street will continue, and we'll continue to track all of those news developments for you. Don't forget to subscribe to this platform and also continue to engage with us on our other social media platforms like Facebook, Twitter, LinkedIn and Instagram. Until then, many thanks for tuning in.